some economists are calling this latest federal budget one of the most irresponsible in recent memory. So today, I'm going to go through what our latest budget means for people's borrowing capacities going forwards, what it means for inflation and interest rates, what it means for supply in the property market, and ultimately why I think the federal government may have just reset our property market. Let's go. Hello, it's Nero here, and let's begin by looking at the Stage 3 tax cuts and what that means for people's borrowing capacities and cash flows. So as you can see in this table here, almost everyone is getting a tax cut. At someone who's earning $30,000, their tax cut is $354 a year, all the way up to people earning $200,000 or more, they get a tax cut of $4,500 per year. Now, what does that mean though? You see, because on their own, these tax cuts boost household cash flows by the equivalent of 4 interest rate reductions. So in other words, according to this article, many mortgage holders will find themselves in a cash flow position as if interest rates were almost a full percentage point lower. Now, what that then means for borrowing capacities is that there'll be many people out there who can't afford to buy property right now who will be in a better position from July 1st. We already know that in multiple areas around the country, there's more demand than supply, and these tax cuts will now increase demand, putting further upward pressure on the property market. But that's from a demand perspective. What about then the supply issue? Isn't the government spending big money to increase supply in our property market? The federal government has unveiled $6.2 billion in new housing spending in this year's budget, with a major focus on housing for Aussies doing it tough. With near record low vacancy rates nationally and an increasingly ambitious housing target of 1.2 million new homes, which I'll come to in just a moment, the $6.2 billion package aims to unlock more affordable housing, ease up infrastructure bottlenecks, and boost student housing, all without fueling inflation. Now, firstly, let's address this 1.2 million homes in 5 years. I've spoken about it in the past. When you look at this chart, you can see that we should be building 240,000 homes per year in order to build 1.2 million homes in 5 years. Now, the blue line, which is tracking how many homes we're actually building, as you can see, is falling. We're actually falling further and further away from this target. So no matter what the government says, we have next to no chance of hitting this target, which means that the property shortfalls around the country are set to continue for quite some time yet, while demand continues to increase. However, there are 2 things with this spending package that you need to be aware of. Number 1, housing infrastructure. To boost the supply of new housing, the government has focused on housing infrastructure. So we're not talking new houses, we're talking infrastructure. So the government will provide the states and territories with a further $1 billion to deliver new housing infrastructure, including roads and connecting essential services. But there is a second aspect to be aware of, and this is where the property reset really could happen. For example, in New South Wales, even though the New South Wales State Premier has openly admitted they won't be able to reach the housing targets set for them by the federal government, they're still aiming to increase supply, and they've identified a number of locations around Sydney and regional New South Wales where they plan on rezoning land to make it more high density to increase the amount of supply. Now, in any area where supply is increased drastically, that will compromise on capital growth. So when we're talking about the New South Wales rezoning plans, we can see here that the New South Wales government says it will master plan and rezone various precincts by November 2024 to deliver up to 45,000 new and affordable homes within walking distance, so 1,200 meters of these key stations. The rezoning document also lists a further 30 suburbs across New South Wales where land will be rezoned around train stations. So that's New South Wales. The equivalent applies to Victoria, Queensland, and most of the other states as well. So when you're looking to buy property, you need to understand that yes, we have an overall supply shortage. The federal government can't fix it right now despite their best efforts. The budget falls short, but in certain locations, they will be aggressively increasing supply. So on a micro level, certain micro markets could struggle with oversupply in the coming months and years, which will compromise on capital growth. So you really now want to be careful about saying, which areas do I need to avoid because they're at higher risk of oversupply? Due diligence, looking at individual pockets of areas will be very, very important for property investors going forwards after this budget. Then the biggest question most people are asking, will this budget increase inflation? Are interest rates likely to rise as a result of this budget? The short answer is no. And that's just not me saying it. The 10-year bond market has barely moved since the budget was announced. The 3-year bond market has barely moved. The Aussie dollar versus US dollar has also stayed the same. So even the markets are not expecting a massive increase in inflation. So rather than relying on people's opinions, look at what the market is saying, and the market's saying interest rates won't rise as a result of this budget. Here's why. If you look at household spending and household consumption right now, it is falling rapidly. Some parts of the media are talking up the stage 3 tax cuts. We've known about these for over 12 months. The RBA in their forecasts have known about this. We know their forecasts haven't been great over history, but at least this is a known factor. Treasury forecasts that inflation will actually fall more quickly than what the RBA forecasts. So what I think you're going to see is a lot of noise in the media from certain people talking about interest rates rising. They're not. They will stay where they are probably until the end of this year, maybe early next year, and then they're going to start to fall. We know the economy is going down the toilet. Property prices, though, are going to continue to rise on a macro level because demand is going to continue to rise faster than supply. But you need to do your due diligence more than ever, because with the government's spending plans to try and address the housing crisis, they're going to only end up doing it in certain areas. Those are the areas you need to avoid. You need to look for the areas where demand is higher than supply and where affordability is still good for the average person looking to live there. Those are the areas that will rise the fastest, and that's where you're going to see the property market really reset. Some areas are going to take off, while others will stay where they are, maybe even slightly fall. So if you want to know then which areas to avoid, how do you do your research, how do you find those areas with the strongest growth potential, check out the link in the description below to get totally for free the audio version and digital version of my book. Otherwise, I'll see you next time.